We'll cover the leverage that closed-end funds use, the leverage profile, and some of the trends that we've been following. My name is Greg Fayvilevich. I head up the U.S. funds team at Fitch Ratings. Our group assigns ratings to debt and preferred shares issued by the closed-end funds. And we also do research on trends in the industry. Before we get into the slides, I'd like to mention a copy of the slides is available on our desk outside. If we ran out, just feel free to leave your card. We're happy to send you a copy of the slides. And also, if you're interested in joining our distribution list for some of the other research that we put out, same thing. Just leave the card over there, or you can talk to me. Happy to add you to the list. With me, we have a distinguished panel. We have representatives from the fund side, the bank side, and the investor side as it relates to closed fund leverage. So to my left, I'll introduce him, Curtis Holloway from Calamos. He's the CFO and treasurer for the funds, in charge of managing the leverage. Brian Knudsen, he works with me at Fitch on closed-end funds. Andrew Hanson from Morgan Stanley, who does private placements for preferred shares with primarily insurance investors. And Steve Nelli, who's with Wells Fargo, working on the credit side, and in the capacity of Wells as a buyer of preferred shares on the municipal closed-end fund side. So let's see if this works. Would you mind just taking the little focus thing, focus box off? Okay, thank you. Okay, so what we're seeing here is the leverage ratios for closed-end funds. On the left side, you have taxable closed-end funds. On the right side, you have municipal closed-end funds. The information is from financial statements that we at Fitch collect for closed-end funds. And you can see for municipals, they tend to cluster around the high 30s, low 40s%. And for taxable closed-end funds, they cluster, they're more varied probably, but they still cluster around 30%. And I'll turn it to Brian. Brian, if you don't mind, maybe covering some of the drivers of where funds manage the leverage ratios and how they look at them.
Yeah, so the base limitations for closed-end funds come from the 1940 Act, which restrict debt usage to 33% leverage and preferred shares to 50% leverage. Additionally, lenders will put on more conservative limits on top of this. So for instance, one example of this is the 45% effective leverage ratio test that we see in municipal preferred shares. Taking a look, as Greg mentioned on the chart, you see that the taxable closed-end funds tend to cluster around 30%. The majority of these are just using debt facilities to fund their leverage. Any funds above that 33% limit are either using preferred shares or non-traditional leverage to get above that 1940 Act limit. Taking a look over at the municipal side, those do tend to cluster in the higher 30s. These municipal funds tend to use preferred shares for their term leverage and tender option bonds for their flexible leverage.
Thanks, Brian. And Steve, so you cover the funds from the credit side, particularly on the muni closed-end funds. Can you talk about some of the parameters you look at as it relates to leverage ratios?
Sure. So I am reasonably new to this space, although I've been in the industry, financial industry for over 30 years, I hate to say. I'm a classically muni-trained analyst, and Wells, we found our way into the closed-end fund space almost by accident. As the auction rate preferred market collapsed, we have both muni clients and investor clients, and our investor clients came to us, many of you in the audience, funds came to us asking, was there something we could do? As you're probably well aware, the auction rate preferred, it was a perpetual preferred. As a bank, we weren't going to do a perpetual replacement. So the leverage tends to be much shorter. We've gone out as far as 5 years, but most of the times it's 3 years. So we're providing the leverage on the fund. We're the preferred investor. And as you know, we're even seeing the leverage start to even come in under 3 years. But we're really looking at 45% is the covenant that we set that the leverage can't exceed. And typically the VMTP, or municipal term preferred security as it's called, will be something maybe in the 30 to 35% range, and most funds will use tender option bonds, which, if you don't know what tender option bonds are, they're repo for tax-exempt assets. Repo doesn't work on a tax-exempt because the tax exemption gets lost in the mix. And that will usually be the swing leverage. So maybe 5 to 10% of tax-exempt funds leverage will be in that tender option bond or repo type leverage. And then you'll have the core leverage, which is maybe in the 30 to 40% range.
Thank you. And let me turn it to Curtis. So Curtis, in your role, you help manage the funds, the Calamos funds leverage. Can you talk a little bit about how you do that, target leverage ratios?
Certainly. So with the coverage that we are limited to from the 40 Act, Section 18, as Brian had mentioned, dictates what our coverage can be, whether it's margin loans at the 33% level or 300%, or the equity, the preferred that we also have, which is governed at the 200% level. So we're looking at our coverage levels on a daily basis, and with that, we also have covenants for our preferred, where it's a little bit similar to the 44%. So it's like 225% coverage. So we're monitoring that on a daily basis. We are, we usually have meetings with the PMs on a periodic basis to see where their view of the market is, whether there's volatility in the market. We share out some of our sensitivity analysis. Let's say if there's a 10% to a 20% correction in the market, where does that put our levels? So we'll see where whether we need to dial back via our margin loans, or whether we feel that if we're bullish, we'll add in a little bit more leverage.
Thank you. Okay, we'll move forward. So this is just a snapshot of the debt and preferred shares that Fitch rates in the closed-end fund sector. We have about $30 billion of rated leverage across 220 funds. You can see a big portion of it is in the municipal closed-end fund sector, as Steve alluded to. It has to do with the taxability and the ability to pass tax-exempt income to preferreds. But there's also obviously a good portion in the taxable side. Taxable funds that use leverage that we rate include high yield, loan funds, MLP. MLP funds used to be one of the biggest issuers of debt and preferred shares. We have some utilities and real estate funds. And you can see that a lot of it is very highly rated on the municipal side, generally in the AAA category. On the taxable side, can also be AAA, but more often in the AA category, primarily because of credit facilities that are more senior to the rated preferred shares. And the reason really that a lot of this is rated so highly is because of the structural features that are built in, the deleveraging mechanisms, and you've seen this, or we've seen this, these structural features actually work in a number of case studies. We've been rating closed-end fund leverage. Prior to the financial crisis, we've seen the funds go through the crisis, and for example, as well as the more recent energy market decline in 2015, 2016, and the funds performed, or the leverage performed as expected generally. If they hit certain of their triggers, they will have to delever, as was alluded to already. Often the fund managers will take down some of the more flexible leverage forms like credit facilities or TOBs, and then move down the line, maybe to notes or preferreds. So seeing some of these mechanisms work through real-life examples has been very helpful in validating the high credit quality of the sector. One more thing I wanted to mention. So this has given Fitch a lot of comfort, and our methodology around rating closed-end funds has been very stable over the last few years. Okay, so moving on to some of the trends. Hopefully you can see what's going on here. So this shows taxable closed-end fund leverage over time. We have a data series that starts around just before the financial crisis. You can see more auction rate securities at that time, switch into more bank financing, and a good portion of preferred shares as well. So again, I'll turn it to Brian to talk about some of the trends. Maybe just to explain first, the data is in 6 months. Period, just because of the way closed-end funds report their financials. And so we've seen over the last couple of periods notional leverage start increasing again. So Brian, can you talk about what's driving some of that?
Yeah, so Greg, as you noted, total leverage is up slightly from last year's conference by about 3%. When taking a look by sector at where this increase is coming from, loan funds and preferred funds accounted for about $700 million total of this increase overall. MLPs were the biggest sector that reduced leverage, and they reduced it by about $100 million. When taking a look by leverage type, we did see about a $1.1 billion increase on bank facilities and bank borrowings, which, as mentioned before, the most flexible and the quickest to employ. We also did see an increase in both public and private preferreds. Andrew will touch on some of the public preferreds on the next slide. In terms of decreases, we continue to see decreases in asset-backed commercial paper borrowings and then preferred shares placed with ABCP conduits. These facilities have been kind of reducing their lending to closed-end funds over the past couple years, and only about 3 funds still have these remaining, and we expect them to roll off over the next few years. Just one more note on auction rate redemptions. They do continue at a slow pace, and only about 55 million were redeemed since the conference last year.
Okay. So moving on to issuance. So this is issuance in the taxable sector, and you can see the MERPs are basically mandatory redeemable, so just term preferred. And Andrew, would you mind walking us through some of the trends we've seen in issuance?
Sure, thanks, and good afternoon, everybody. My focus is on the new issue market for taxable closed-end funds in notes and preferred. So it's relative to the size of bank debt and repo outstanding, it's much smaller, but it's a growing area that continues to have interest from both issuers and investors. Last year, over $1 billion was issued in notes and preferreds by taxable closed-end funds, which is a good year. It's 13 different issuers. It's up about 40% from 2016 in terms of the issuance volumes. It is certainly off the peak of 2013 and 14, where issuance volumes were higher, in large part driven by the MLP funds, given their asset values were much higher than they are today. But still, we're seeing the issuance volume driven not only by refinancings of prior deals, prior notes and preferreds that have come to maturity, but also new funds entering the market. Over half the deals last year were funds tapping either notes or preferreds for the very first time, which is a great development, because the more funds that come in and tap this market, the more the overall market grows. The issuer funds that have tapped this market last year have included MLP funds, which have been mostly refinancing prior deals from 3, 4, 5 years ago, infrastructure funds, convertible bond funds, common stock funds, non-U.S. debt funds, media-focused equity funds, commodity-focused equity funds. So it's a pretty broad range of issuer types within the closed-end fund world. Not so much a concentration on MLP funds as we had a couple of years ago. As Brian and Greg mentioned, the MERPs has become a bigger part of the overall issuance market. It made up a cycle high of 68% of total volume last year. It's MERPS stands for Mandatory Redeemable Preferred Shares, which is basically preferreds with a fixed term on it. Investor demand is very strong for this product due to the higher yields and their comfort with the preferred structure, albeit it's junior to the debt, but it still has strong structural protections from investors. And issuers have shown a stronger and stronger desire to increase their cushions to the 40 Act, which preferreds does. And also to the extent they do fixed rate deals, you're reducing interest rate and renewal risk, and being able to reduce credit facilities, withstand market volatility, and, in many cases, increase leverage above what a fund would otherwise be comfortable with on an all-debt structure in order to maximize the distribution rate to common stockholders. So, it's kind of a win-win, the MERPS product from my perspective. I think that's...
Good, yeah. And Curtis, Calamos did one of these transactions last year where you've taken down some of the debt facilities that you had and added MERPS. Can you discuss that transaction a little?
Sure. So last September, we issued $600 million of MERPS, and those 3 bullet points there are 3 of the 5, I guess, reasons we wanted to do that. So the 40 Act cushion, so when you have a coverage ratio, that 300% that you have to maintain, if you're at the 33% level, then if the market moves against you, then you're going to have to delever. So typically we were under that 30% level or the 33% level. We were in the high 20s. So we didn't have to delever in a down market. Diversity of source of leverage. We did have a secondary source of leverage in our funds, but they were both margin loans. So one was tied to overnight LIBOR, one was tied to 3-month LIBOR. They had different covenants and terms, so that did offer some diversity, but not as much as the preferred. The third item there, the reduced renewal risk. We wanted to lock in some of our interest rate chart costs, and in order to do that, we could either do the swaps or we could issue equity. Swaps seemed to be just as pricey, so we felt that the preferred gives us more leverage as well as opening up some of the 40 Act cushion. A fourth reason is our outlook on the markets. So we felt that we were in a bull market, and I know John just went through a lot of the components of where we feel that where the market is going to take us. We were bullish and thought we could utilize more of that leverage to enhance the portfolio. And then finally, we were looking at, as our portfolios pay out a distribution of about 9 to 10%, looking just ways to meet some of those distributions, and that this was one way to enhance it.
And we'll come back in a little bit more detail on the cost consideration and talking about short-term debt or short-term financing versus longer-term financing in the next slide. For now, let's turn over to the municipal side. More stable there over the last couple of years. Again, we see same trend going back a couple of years where ARBs have been refinanced, but over the last few years, there have been a number of securities that types of preferred shares that have been the most popular. And again, Brian, can you describe some of the trends we're seeing?
Yeah, so leverage in the municipal sector has been about flat since last year. There has been a mix between the type of leverage being utilized, though. We did see an increase in MFP shares, which are muni fund preferred shares. We'll touch on that a little bit more on the next slide. And also VMTP shares. The VMTP shares, a good chunk of that was issued to refinance outstanding auction rate securities, and the MFP shares were issued to refinance IMTP shares that were coming up to their maturity. We did see a reduction in ARBs, as I just mentioned, but the total was about $160 million. And we also saw a reduction in tender option bonds As we mentioned before, the TOBS Act is a little bit more of a flexible leverage option, so this may be some managers trying to dial down their leverage a bit in a short time frame.
And we've seen quite a bit of innovation in municipal space. Again, people kind of moving away from the ARPs and coming up with new types of preferred, first MTPs, which were more for retail investors earlier on, and VMTPs and VRDPs are placed in different markets. And then more recently, we've seen the MFP shares. You mind talking about those a little bit?
Yeah, so the MFP share is a relatively new structure that we saw over the past year and a half. These feature a long legal maturity, but are put into shorter modes. The mode is what really dictates the structural protections, the interest rate mechanism, and the remarketing mechanisms, if applicable. So you'll have a preferred share with a long legal final, but the manager has the ability to switch the preferred share into different modes. So it could be changing the way the interest is being paid or what rate it's referencing. And we do expect to see issuance on this continue, just given the long legal final, as well as the flexibility for the manager to kind of switch between and adjust the leverage terms.
Okay, so now, turning to issuance on the municipal closed-end fund leverage side, you can tell pretty clearly from the chart, 2017 was a very slow year, particularly as compared to 2016, and this year it seems to be coming back. So again, Brian, can you hit some of the highlights there?
Yeah, 2016 was a huge year. There was a lot of large fund mergers where the funds were required to refinance their outstanding preferred shares, basically like for like. So those numbers are a bit inflated and aren't all total new money issuance. Last year in 2017 was a much quieter year with a little bit of MFP issuance. And the first transactions there. However, year to date, 2018 has been a big year. We've seen issuance in VMTP shares, and really the bigger trend is MFP shares. These have been issued to refinance different preferred shares that were outstanding, whether these are IMTP shares that I mentioned before or VMTP shares. And as I mentioned, we do expect this trend to continue.
And Steve, Wells holds, I think, each one of these VMTPs, VRDPs, and the new MFPs. Can you talk a little bit about how you view them differently, if at all?
From a risk perspective, don't view them differently at all. Maybe the more, and I've heard it mentioned on several of the panels so far, that rising interest rates have driven a number of different trends. And I think that's what's driven this trend as well. And it's not just rising interest rates, because what's risen really has been short-term interest rates, but it's the flattening of the curve. And so when you're running a leveraged fund and your goal is to borrow at a higher cost, to invest at a higher cost than you borrow at, as the yield curve flattens, that becomes much more difficult. So I think the reason we've been asked to look at these shorter maturity leverage assets is to also squeeze down the price, to be quite honest. Because if you go back, again, going back to the history, most of this sector was perpetual preferreds. It was perpetual preferreds that had been sold to retail investors, sometimes with maybe it was intimated that it might look a lot like a money market fund to those investors. There were settlements that happened as a result, and then we moved into the institutional provider of this product. Interesting, and I don't know if Greg, if you're going to get to this later or not, but one of the interesting things that we may see, so one trend has obviously been the yield curve flattening, but another thing specific to the muni space is tax reform has impacted municipals. And it impacted municipals a lot because corporate tax rates were adjusted significantly. Individual tax rates, not as significantly. The closed-end fund leverage product has become largely an institutional product, but retail investors realistically will value that tax income higher than an institutional investor. So selfishly, I'd like to say that, that this won't happen, but realistically, I would expect investment bankers on the tax exempt side to look and see if there are ways to re-engage with retail investors who will value that tax exempt income more at a higher level than an institutional will, but probably have to develop ways of delivering that product that are more realistic about the risks.
Thank you. Okay. Now we're on to costs. There's a handful of key leverage forms in municipal closed-end funds, like we said. They can have different cost structures. Some are spread over SIFMA, some will be remarketed, but often in practice they really track SIFMA plus a spread in a lot of cases. So as SIFMA has risen, the borrowing costs for the funds have increased, and SIFMA in fact has been quite volatile. Part of it is tied to money fund reform and the decline in the assets in municipal money funds that buy generally SIFMA-tied, SIFMA-related assets. So we expect that to continue. But Steve, would you mind talking a little bit about some of the factors that drive pricing for you at a high level?
Sure. So for those of you who don't follow the muni market, SIFMA is LIBOR but tax exempt. And SIFMA historically pre-tax reform was roughly, it's just a mathematical rate, it's 1 over 1 minus the tax rate is sort of where SIFMA should average over time. And so SIFMA was roughly 70% pre-tax reform. And for retail investors, they really wouldn't see a lot of change. But for institutional investors who really drive the SIFMA market, as the tax rate went from 35%, marginal tax rate from 35% to the low 20s, SIFMA would, the SIFMA equivalent is really looking more at, like, say, 80% of LIBOR. And we've seen SIFMA resetting anywhere between the low 70s and the high 70s, maybe 80%. But we're not sure exactly where that will come. But going also to the cost varying, as I mentioned before, we're being asked to look at these shorter term leverage products. So either a term out, so the first iteration of taking out auction rate preferreds was a money market eligible what was called VRDP, or a puttable product that was sold out as a floater. We didn't participate in that, largely because we didn't want to add the off-balance sheet risk. If you look at what got banks in some of the trouble they got onto, it was off-balance sheet obligations. As the product morphed into being sort of an on-balance sheet asset, which was the VMTP that Greg has mentioned, we became very interested. That, as I mentioned earlier, was sort of the 3 to 5 year maturity. Certainly a lot less than perpetual, but a nice long tail for the funds. What we're being asked to look at now is a terming out of those VRDPs, typically about 18 months, or even something that Brian mentioned, which is this long nominal maturity, but with puts. And typically the way it works is that we, the bank, give notice that we want to put the asset, typically either 3 to 6 months, and then the fund has another 3 to 6 months to replace us, or else we can put it back. So those are the structures we're seeing, and the price is less because the risk tail is less.
Thank you. And now we're going to move to taxable side. So you can see there's more variability in the forms of the leverage and maturities, but also on the costs, particularly on the short-term side of the bank facilities and the repos. So Brian, can you explain, why do we see so much variability there?
Yeah, so some of the main drivers of variability, well, just taking a step back, a lot of the repo and bank facilities are either trade in line or priced off of short-term rates. A lot of the variability here that you see, for instance, basically the low points on those two figures are driven by euro-denominated borrowings, where interest rates are still low. Additionally, on repo, that's part of that is driven by the collateral type, as well as additional specifics to the specific repo transaction.
And Curtis, from the practitioner side, as a fund manager, can you talk about some of the price mechanisms on the different leverage forms you have, particularly the credit facilities?
Sure. So on the margin loans, we have, our margin loan is tied to overnight LIBOR. We did have some margin loans that were tied to 3-month LIBOR. As you may know, that, 5-6 years ago, or, the spread was a lot lower between the two, and now it's approximately about 65 bips. So the overnight LIBOR is more of a, it has worked out well for us. So with the LIBOR rate, you do pay a spread with that. Also on our margin loans, we have the ability to utilize security lending, and with the proceeds from the sec lend, we would pay down our margin loan, essentially self-finance, but because we have to pay the bank facility to have that money available in case the sec lending market dries up, we pay a lower rate. So we have the flexibility to have a cheaper structure in that regard. And of course, we have the $600 million of MERPs that we talked about. So we've got a 5-year, 7-year, and 10-year maturity on those with about a 4% rate.
And Andrew, you're close to the investors that buy the MERPs. Can you talk a bit from their perspective, how they price them and how they look at the maturities?
Sure. Yeah. As I said before, investor demand for MERPs and notes is extremely high. Continues to be very strong. Insurance companies, pension funds are the predominant investors. There is a perpetual preferred market for taxable funds. That's oh, it's not on that one. Oh, we should be on the next slide, right? Yeah, there we go. So the perpetual preferred market right now is, sort of 5 to 5.5, which is the most expensive. But if you think about this chart, it's sort of the longer you go in maturity and the deeper subordination you go, the higher the cost is going to be. So there's investor demand all across the curve and all across the products. I would say that credit spreads are really what the investors, that's the impact we can have on a deal, is how tight we can get credit spreads. Obviously, the reference rate, whether it's LIBOR or Treasuries, is something we just have to take for what it is. So the credit spreads have stayed, I would say, pretty aggressive. Naturally, the credit spreads get a little bit wider the longer you go out the curve, but most of the increase in cost is just from the risk-free rate and the yield curve. I will say that the rates have gone up. The risk-free rates have gone up. We'll talk about that in a second. And so what you find is, I think Calamos is a great example, is that rates today are quite a bit higher than they were less than a year ago. So I think some funds that maybe also took a view on rates, have benefited from locking in. We'll talk in a second about where rates headed from here, but investors don't seem to be too concerned about rate timing. They're really just buying product as it comes, and as rates have risen over the last year or two, they've continued to have just as much demand for the product, if not more. So spreads have kind of, on balance, probably tightened a little bit.
And on a related topic, we talked about the flat curve already and kind of the pricing dynamics between the short-term funding and the term funding. Andrew, can you elaborate on that a little bit?
Yeah, so I think the last time I talked to the panel 2 years ago, LIBOR had been bounced. This is 3-month LIBOR. So to Curtis's point, the overnight or 1-month LIBOR is lower than this, but 3-month LIBOR, had been bouncing around 25 to 40 basis points for 2013 through 2015, and today it's 2.3%. So it's a dramatic shift in interest rates, as all of you guys know. That has put, as the title says there in Wall Street Journal quote, not just the closed-end fund world, but even maybe more so the corporate world, has put a squeeze on borrowers who have relied sort of exclusively on short-term borrowing. What's also interesting is the yield curve is flattened. So, we looked at the blue line there is the 10-year Treasury yield, and the difference between that and LIBOR has shrunk dramatically. So now the premium to term out debt or preferred is much lower. So query whether this will be an enticement for some closed-end funds to term out, either in the form of issuing preferreds or longer-dated notes. Because if you think about 2 years ago when we looked at this chart and LIBOR was 25 basis points, the forward curve of LIBOR in 2 years showed it supposed to go to 1% or 1.25%. So it's actually gone to 2.25%. If you look at the forward curve today, looking forward 2 years, it's supposed to get to 3% from 2.25%. So will we overshoot that again? Possibly. And will those borrowers who lock in this year for 5, 7, or 10-year MERPs be happy they did 2 years from now? I think that's the bet that many will make in terms of kind of locking in cost of leverage.
And Curtis, anything you want to add to that?
Well, Andrew covered a lot of the rates, but I know that when we launched it in September, rates have gone up 100 bips, saving us $6 million. So I think we were very fortunate to get in when we did and lock in some of the rates.
Thanks. So cover this on the muni side and realize we're quickly running out of time, so maybe we'll go through the next slides fairly quickly. We did a research piece recently about an ARPS update, about 10 years following their the ARPS crisis. They froze in early 2008. Brian, you want to cover that really quickly?
Yeah, I mean, I guess the short story of this now is that, to date, 2018, we've seen about double the redemptions that we saw in the full year of 2017. It's getting to the point where the maximum rates have become less competitive against the alternative financing. So the decision in the past where it's maybe been more by activist investors who purchased the ARPs, it's shifting now to a more economic decision where it makes sense for both the common and the manager and the preferred to switch to a different type of financing.
Okay, thanks. And then we typically just give an update on the bank financing market, so which banks are kind of at the top spots. And the biggest change to highlight maybe from last year's panel is State Street up about $2 billion, and that has to do with some of the changes that Curtis was alluding to in terms of how they do their financing. And we have a couple of slides just talking about the leverage ratios. You can see them for the different subsectors. And we have some brief explanations about the various leverage forms. So again, you can see those on the slide, so I'm not going to go through all of that. But we thought maybe we'll open it up for questions if there are any. No? Okay, then I guess we'll finish. Thank you.